Time for Past Picks now with David Burrows, the President and Chief Investment Strategist at Barometer Capital Management. We're looking back just about 13 months or so to Telus. Now, keep in mind, since then, there was a 2-for-1 stock split. You're up here 21%. That includes the dividend. Are you pleased with that?
We're very pleased with it. I will say that in the spring of this year, we did reduce our exposure to the telcos as we were increasing our economic sensitivity. But within the group, really the Telus, I think, is the strongest, just because they've been so vocal in their support of shareholders with saying, we will raise our dividend 10% a year for the next 3 years. They continue to look that way. They've been very good at returning capital to shareholders, and it probably has the best dividend growth going forward of any of the telcos.
Is this year 2 of their dividend plan, or year 3, or? Well,
they went through the first 3 and then re-upped for another 3.
Another 3, right.
And also talked about how much, how many shares they'll buy back. They have great growth in their mobile business, and they've got a really good business in healthcare. And we think that there's more value there in the shares.
Is it important to you, David, that Telus sticks to its knitting, so to speak, and just does telecom, doesn't bother with content like BCE and Rogers?
It's easier to analyze, certainly. And we think that the core pieces of the business are very attractive. They have, very little legacy landline business. So it's a pretty clean investment. And you couple that with a very shareholder-friendly management group. I think people will pay for certainty, and when management comes and says we have the confidence to tell you we will raise our dividend, twice a year for the next 3 years, investors will pay a multiple for that.
You also recommended about 13 months ago Interpipe, and this one pays a healthy dividend. It's up 19%, solid gain here. Have you been pairing this at all?
It's interesting, we invested in Interpipe basically when it went public. And in our strategy, we believe in finding good getting better and staying with them as long as they work. And surprisingly, IPL has really worked for a long time. So it's been a core position for us. You do trim little bits here and there, but the fact is you like to stay with the ones that work. And so we have a pretty good sized position in Interpipe.
Let your winners run, you like to say.
Listen, in a good market, stay with the ones that are working. Be prepared to carve out the ones that don't work quickly without letting them hurt you too badly.
You also recommended cash 13 months ago. How much were you recommending as far as percentage?
So we're a very tactical manager, and when there is uncertainty, we have no hesitation to go to cash or to hold cash. And if you think back to the early last fall, there was lots of things going on from a macro perspective that caused concerns, a lot of them around Europe and Asia. So we did have some cash at that point. We have been basically fully invested since November, December of last year, and we are fully invested today because we are very constructive on equity markets.
And just generally, David, those are your past picks. Just a bit of time here. Can you give us more? Can you expand more on your idea that this bull market may have some more years to run here?
Well, if you look at it, if you went back over the last 100 years, there have been a series of secular multi-year bull markets, 15 to 20 years in length. And in every case, at some point, they wound up over-owned and overpriced, and it took many years of sideways choppy markets to wash out that over-ownership. In each case during those periods of time, price earnings multiples contracted as people were willing to pay less and less. In every case, when you came ultimately out of those sideways consolidations, you were in a new secular bull market. When we look at the market today, we've been up and out of that trading range we've been in the S&P for the last 12 years for about the last 8 months. Price earnings multiples are expanding for the first time since the last secular bull market. Inflation is falling. Consumers getting a little bit stronger. When we look at the extra return we get for equities versus fixed income, it's a very significant premium you get paid on the earnings yield of the S&P versus the yield in the 10-year bond. So there's good valuations, markets behaving well. We think there's some legs to go.
All right, very good, David. Let's take another break here, and we'll come back. We have another half an hour to go here. More of your questions on North American large caps for David Burrows after this.